latest ALTA Insights webinar. I'm Jeremy Yowie, ALTA's Vice President of Communications, and thank you for joining us today. There's definitely a lot of interest in today's topic, as we've had nearly 750 people register for the webinar. So again, thank you for taking some time. We're going to talk about the recently published new and revised endorsements, including the ALTA 49s that were designed to allow homeowners to add coverage, offering post-policy protection against forgery of a deed or mortgage. With the average title insurance fraud and forgery claim costing over $143,000, these crimes are definitely can be devastating to households. So these endorsements set the standards for forgery protection and build upon ALTA's landmark homeowners policy of title insurance. In addition to these endorsements, our speaker will also discuss new endorsement for solar equipment on residential transactions, as well as revisions to several other endorsements to align with the 2021 ALTA policy form standards. Before starting, I have a few housekeeping items to go over. A copy of today's presentation can be downloaded from the handout section in the GoToWebinar window pane. Today's webinar is being recorded. You'll get an email with a link to the recording tomorrow. It will also include a link to download a copy of the presentation as well. And you can always access ALTA's webinar recordings at alta.org/webinars. I need to thank DataTrace for sponsoring today's webinar. And before introducing today's speaker, we have a short message from DataTrace.
Find the right starters in seconds. Starter IQ is the premier marketplace to locate and leverage starters from our diverse network of contributors. As a contributor, you can effortlessly access your own starter records and increase your revenue, all while streamlining your title search and fulfilling underwriting requirements. Using starters shortens turnaround time, reduces costs, and minimizes risk by leveraging established and reliable information. Title-driven intelligence supplies the highest-rated recommended starter and expansive search options, GIS mapping, and enhanced property indexing to pinpoint the right record. Intelligent Type Ahead locates the subject property before you're done typing, and Starter IQ identifies all starters for your property, surrounding parcels, and even entire subdivisions, highlighting the most recommended at each level. And you can even find your property using a simple deed or mortgage reference. Submit your starters and earn a share of the profits when others purchase them. We'll store your starters for you, so there's no need to maintain a database. Find the right starter in seconds with Starter IQ. Maximize your efficiency, reduce your costs, and profit from your contributions effortlessly.
All right, thank you, DataTrace. Starter IQ, a little timely message as we're talking about policies. Let me move some things here on my screen real quick here. All right, there we go. All right, now we can get to the main event, introduce today's speaker. Joining us today is Dan Buchanan. Dan is Senior Vice President and Deputy Chief Title Counsel in the Corporate Underwriting Department of First American Title Insurance Company. He is also Chair of ALTA's Forms Committee, which recommends new forms or revisions of existing forms to keep coverage responsive to the needs of insureds and the industry. Dan also serves on ALTA's Title Council and the Native Lands Work Group. And in addition, Dan was recognized by ALTA with the 2022 We Protect Our Values Award. Dan, thank you for everything you do for the industry, and thank you for joining us today. And I'll turn the presentation over to you.
All right, well, thanks, Jeremy. And good morning or good afternoon, everyone. Thanks for joining. The first part of this presentation, I'll be talking about the ALTA 49 and 49.1 endorsements. If any of you were at ALTA 1 and sat in on my presentation during ALTA 1, the first part of this will look a little bit familiar to you. but then we'll get into some other things. We're going to talk about the ALTA 49 and 49.1, as well as the ALTA 50, the residential solar endorsement for loan policies. And we'll finish up by talking about some revisions we made to existing endorsements. And that's sort of a minor but important change to those endorsements, pretty much the same change for all of them. And we'll wrap up with a discussion of that. If there's time left, we'll try and take some time to talk about or answer questions that you might have. But let's get started. We'll talk about the ALTA 49 and 49.1 initially, and these endorsements add post-policy or post-endorsement forgery protection to residential owner policies. Let's talk a little bit about why we're doing this. Those of you familiar with the homeowner policy know that we have been providing very critical post-policy forgery protection for more than 20 years through the homeowner policy. That policy is not available in some states, including some very large, important states like Texas and Florida. And the homeowner policy isn't widely used in a few other states, and there may be specific transactions where the homeowner policy isn't available for some other reason, typically an underwriting reason, where the nature of the property just creates an unreasonable risk for the extensive coverage that the homeowner policy provides. One of the value propositions of the American Land Title Association is the both public and political awareness of the value of title insurance, and it's really a critical function of ALTA's mission to take the lead in consumer protection. Let's move on to the next slide. There we go. So over the last couple of years, deed theft stories have started making headlines. You can't pick up newspaper, or real estate oriented periodical these days without seeing stories about deed theft. Typically stellar impersonation situations where somebody identifies a piece of property, pretends to be the owner, tries to sell it and collect the money and disappear. This has gotten so many so many headlines that people have come into the market with odd or ineffective products trying to address this issue. Notification subscriptions that people are paying for. There's a number of different products. I'm not going to get into the nature of these non-title insurance related products, but we all see the advertisements on late night TV, and we all get questions from consumers about, should I be signing up for one of these things? In addition, because this has become such a visible issue to the public, it's become a visible issue to legislatures, and states have started taking up discussions and consideration of legislation on how to address. And what we've seen around the country is some of the legislative proposals for dealing with deed fraud are not well thought out and potentially harmful to the integrity of real estate records and the entire closing process for real estate transactions. And so the ALTA board wanted to do what they could to try and find a way to again take a leadership role, especially to find a way to provide some expanded protection for consumers who don't have the homeowner policy or access to the homeowner policy. And so the Forms Committee was asked to come up with endorsements that would address this issue. The result was the ALTA 49 and the 49.1. They were published by ALTA on August 19th of this year. The best way to understand an endorsement is to actually read it. So let's take a look first at the ALTA 49. The title of this, the formal title of this endorsement is the ALTA 49 Endorsement Forgery New Owners Policy Residential. It's a mouthful, but appropriately descriptive. The endorsement begins with a definition section. It draws on the 2021 ALTA Owners Policy of Title Insurance for any capitalized term that's not defined in the endorsement, and that includes terms like land or title. So it even if the policy is not a 2021 ALTA Owners Policy, it draws from that policy for defined terms. I think these days, most new policies being issued are the 2021 policies, but that was an important element. We wanted to make sure that the terms are properly defined as we use them in the endorsement. It also includes defined terms for estate planning entity and natural persons. Those of you familiar with the homeowner policy will recognize these terms. They're defined in the homeowner policy. These are the same definitions as used in the homeowner policy, but but because this endorsement is being attached to a policy other than the homeowner policy, it was necessary to define these in this endorsement. The endorsement then goes on to establish the requirement or the requirements or conditions for its issuance, and that includes that the land is improved with an existing 1 to 4 family residence, same as the homeowner's policy. Each party named in item 1 of Schedule A is a natural person or estate planning entity. Again, that matches the homeowner policy. And the endorsement must be, the 49 is issued at the same time as an ALTA owner's policy and not an ALTA homeowner's policy. It's very important that this endorsement be used on the regular owner's policy, not a homeowner policy, because the ALTA homeowner policy already has post-policy forgery protection built into it. And in a little bit, we'll talk about the differences between those coverages. So this endorsement could be issued with a 2006 owner's policy, but like I said, these days I think pretty much everyone is now issuing the 2021 ALTA owner's policy. And so as long as the property is 1 to 4 residential, the insured is a natural person or their estate planning entity, this endorsement is appropriate. And then let's go on and look at the next set. So the coverage language in this endorsement is found in paragraph 3. Company insures against loss or damage by reason of a defect in the title caused by the forgery of a deed or mortgage recorded in the public records after the date of policy in which the insured was impersonated as the grantor. So the coverage provided in the ALTA 49 endorsement is prospective coverage. It's for a forgery that takes place after the date of policy. Other covered risks in the owner's policy already provides coverage to the insured for forgeries in the chain of title before they take title. So if their seller acquired title by a forged deed, that's already covered. This adds coverage for a forgery that takes place after the date of policy. The coverage in this endorsement is limited to the coverage for a forgery of a deed or a mortgage that ends up being recorded in the public records. That there's an important distinction there between this coverage and the coverage under the homeowner policy, and we'll talk a little bit about why that difference or distinction exists. The endorsement also needs to address the post-policy exclusion, and that's what paragraph 4 does. Exclusion 3D of the policy excludes coverage for matters that occur after date of policy. And so for the purposes of this endorsement, the endorsement says that exclusion 3D does not apply to the coverage provided in this particular endorsement. Let's talk a little bit about the difference between the coverage in the ALTA 49 and the coverage in the homeowner policy. At the bottom of your screen, you'll see the coverage language in the homeowner policy. Someone else claims to have a right affecting your title because of forgery or impersonation. That's very, very broad. By contrast, the coverage under the ALTA 49 addresses a forgery of a deed or mortgage recorded in the public record in which the insured was impersonated as the grantor. So when we set about working on creating these endorsements, we started with the proposition that we would simply use the language from the homeowner policy. Someone else claims to have a right affecting your title because of forgery or impersonation. But there were concerns expressed that that sweeping type of coverage that goes beyond simply protecting the integrity of the public record from forged deeds or mortgages would potentially prevent these endorsements from being adopted in states that don't currently allow for the homeowner policy. Texas and Florida and a few other states do not permit the issuance of the homeowner policy because the broad coverage in the homeowner policy, including many of the post-policy coverages that it includes, blur the boundaries of the definition of title insurance in those states. And so we did not want to create an endorsement that ended up not being available in states where the homeowner policy is not available. We are really trying to create a product that regulators in those states will accept and allow us to issue in order to provide the more narrow coverage that is described in the coverage paragraph of the ALTA 49. There was also a concern that we did not want to diminish the value of the homeowner policy by creating an endorsement that simply matched that that same coverage. Now, granted, there's a lot more coverage under the homeowner policy as compared to a standard ALTA owner's policy, but we still we're concerned about wanting to maintain the homeowner policy as the gold standard in the industry for coverage for residential property owners, and so because of that, the coverage language in the ALTA 49 and in the 49.1 we'll go through in just a moment. It's a little more narrowly tailored. We wanted to be able to make the regulatory argument that this endorsement is designed to correct a defect in the title, and that it is focused on maintaining the accuracy of the public record, and that's why the endorsement is focused on dealing with a defect in title caused by a forgery of a deed or mortgage recorded in the public record. So I hope that makes sense. Like I said, there were really kind of two factors involved here. One is starting with the homeowner policy as our base for moving forward with the idea of focusing this coverage on residential consumers, which is why we've incorporated the same limitations of natural person and improved residential property. So very consumer, homeowner focused coverage, and narrowly, a little more narrowly designed than the broad coverage of the homeowner policy in order to maximize the possibility of adoption in states with statutory or regulatory schemes that have limited or prevented the homeowner policy from being available. People have asked why the limitation on improved residential property when so much of the deed theft and seller impersonation that's taking place is focused on unimproved property or vacant land. And there's a couple of reasons for that. One is, again, we did not want to create an endorsement that went beyond the homeowner policy. We want the homeowner policy to be, you know, the gold standard. So we wanted it to have the same constraints there. And the industry has some claims and actuarial experience with, you know, the seller impersonation on improved residential property. We really don't with respect to the, you know, the unimproved or, you know, vacant property claims. And so there was an element of proceeding a little bit cautiously in what kind of liability the industry may be taking on. And so again, we didn't want to go beyond the homeowner policy, so it has the same improved residential property and natural person limitations. And we dialed it back a little bit from that in the hopes of getting it approved in states like Florida and Texas. All right, let's talk a little bit about the 49.1. In addition to making an endorsement available to those people who are getting a new policy, but for some reason are not able to get the homeowner policy, there was a desire on the part of the ALTA Board of Governors to offer a product that could be available to homeowners who already have a policy, don't need to get a new policy, but want to add this coverage. And so the 49 addresses that. The 49 is an endorsement to be issued to an existing residential owner's policy, again, but not an existing ALTA homeowner's policy. Like the 49, the endorsement begins with definitions, including the incorporation by reference of the defined terms from the 2021 ALTA owner's policy. It includes the definitions of estate planning entity and natural persons. This endorsement includes a date of endorsement blank. So that's important because we have to establish the point in time in which this coverage begins. And so when asked to issue this endorsement, a date will be inserted, and that's the beginning date of the coverage under this endorsement being added to that existing owner's policy. Again, paragraph 2, like in the 49, requires that the land be improved with an existing 1 to 4 family residence, and that each party named in item 1 of Schedule A is a natural person or estate planning entity. And then it goes on to require that it be issued to the company's existing ALTA owner's policy that is not an ALTA homeowner policy of title insurance. The reference to the company's existing owner's policy is important. There was a discussion, should this endorsement be able to be issued by a company to anyone's policy? And there was a determination that no, it really doesn't work if it is not attached to the same insurer's policy. And so it can be issued by any policy issuing agent or company, insurer that has issued the underlying owner's policy, but it has to be issued to the same, the endorsement has to be on the same underwriter's paper as the underlying policy. Let's go on to the next slide. Again, the coverage paragraph is found in paragraph 3. As with the 49, it insures against loss or damage by reason of a defect in title because of a forgery or a deed or mortgage recorded in the public record. The 49 says after date of policy. This endorsement says after date of endorsement. So again, the coverage is forward looking. It does not, if there is a forgery in the chain of title between the date of policy and the date of endorsement, this endorsement does not cover that. It doesn't address that. This is forward looking, so it only provides coverage if the if the forged deed or mortgage is recorded in the public record after the date of endorsement. Like the 49, we agree that we will not assert the post policy exclusion, but in this one, in this endorsement, we also, for the purposes of the endorsement, modified the known to the insured and not known to the company exclusion. And so we exclude from coverage matters that are not known to the company but are known to the insured and not disclosed prior to the date of endorsement. So what this means is that if somebody comes to us and wants to get this ALTA 49.1 endorsement added to their policy because they know somebody is forging documents with respect to their title, or there is some kind of dispute over the legitimacy of documents that have not yet been recorded, we expect the insured to disclose that to us in connection with the endorsement. And if they fail to do so, then understandably we would want to be in a position where we could deny that coverage. So that basically wraps up the 49 and the 49.1. Hopefully that gives you an idea of why those were created and why they read a bit differently than the homeowner's policy. There are efforts underway to get these endorsements filed. They're not filed yet in either Texas or Florida, but we have hopes. So that is part of the goal.
Hey, Dan,
yes,
real quick before we transition to the ALTA 50, we had a couple of questions on the date of the endorsement. And the date is the date that this endorsement is issued. You're not retroactive in dating it back when the original policy was issued, right?
That is correct. On the 49.1, the date of endorsement would be the date that the company issuing the endorsement inserts, and so it would be the issued date of the endorsement. It could be everyone will need to check with their particular underwriter as to what their expectations and requirements are. It could be that it's simply the date that the endorsement is prepared and delivered to the insured. It could be the date at which the title can be dated down. So it might be backdated to match plant date, that kind of thing. But it's not intended to be the original policy date. It's intended to be a current date. But I think each underwriter will provide guidance as to what date they believe is the appropriate one.
Okay. All right. Thank you, Dan.
So let's turn our attention to the ALTA 50. This is an endorsement that adds coverage to a loan policy related to residential solar equipment. And like we did with the 49s, let's talk a little bit about why we thought this endorsement was necessary. When a property owner doesn't outright own solar equipment that is placed on their property, it is very typical that the public records will show a UCC financing statement recorded, or a lease agreement, or a power purchase agreement. There are a number of different ways that solar equipment is provided for residential property owners, apart from them just like paying cash and or paying the vendor cash and financing it with a a second mortgage on their property. And so typically solar financing statements, solar lease agreements, or power purchase agreements mean that someone else owns that equipment. The leasing company, the power purchase provider, the financing company, and in most of these cases, these are documents recorded in the public record, so they're picked up on title searches, and are typically reflected in the in Schedule B of the the commitment or title policy, and that creates a concern for lenders. They want to know that the lien of their mortgage on the title to the property is superior to whatever interests are claimed with respect to the solar power equipment. The GSEs, Fannie and Freddie, in their residential lending guides and requirements, have addressed the issue of solar equipment because it has become complicated. They don't allow appraisers to consider the value of solar equipment that is not owned by the property owner, and they require lenders to ensure that these types of financing statements and agreements do not have a superior lien or position with respect to the title of the property. And so it's been a struggle historically when there is recorded documents regarding solar equipment reflected in the public record, and we're trying to ensure a refinance or a sale transaction, and give a lender a policy that they think is acceptable. And what we've discovered is that these documents don't purport to put a lien on the title to the real property. They purport to create a lien or an interest or reflect an interest in the equipment itself and not the real property. There was some thought at one point in time, well, maybe we could show all these documents in Schedule B Part 2 as being subordinate to the lender's mortgage. That's not really appropriate because they're not subordinate. They are a lien on some piece of equipment that doesn't belong to the property owner, and the foreclosure by the lender does not extinguish these financing statements or lease or power purchase agreements. So they're not truly subordinate to the lender's interest. And so CLTA, the California Land Title Association, had come up with a solar equipment endorsement that found some popularity and acceptance in the western part of the country, but ALTA thought it would be appropriate to try and find a national industry standard that worked for Fannie and Freddie and worked for us on the insurer side. And so what we've come up with is the ALTA 50 endorsement. So let's take a look at the language of that endorsement now. Like all of our endorsements these days, if there are defined terms, the endorsements now always begin with the defined terms. And so the the endorsement creates definitions for solar energy system, which refers to solar panels, shingles, and appurtenant equipment located on the land at the date of policy. We have a definition for power purchase agreement. Those not familiar with it, that's basically an agreement where the owner of solar generation, electric generation equipment, puts their equipment on your property and then sells you the power that it generates for, you know, a savings over what the the grid power, might cost you. A solar panel lease is just, what you would think it is. It's it's equipment owned by a energy system provider that's installed on a property and then leased to the property owner. So the ownership stays, with the other company. And then a solar financing statement is a UCC financing statement evidencing a security interest or lien on the solar systems. This endorsement is only intended for residential property. Paragraph 2 limits the endorsement to improved residential property. And let's go on and look at the next slide. The coverage of this endorsement is really stated in paragraph 3. We insure against loss or damage to the insured by reason of a judicial determination that the solar power purchase agreement, solar panel lease, or solar financing statement constitutes an estate or interest in the land or a lien upon the title. And so basically what we're doing here is we're ensuring that the equipment is, that the documents reflecting the ownership or financing of this equipment does not affect the real property and is not a lien on the real property. That's what the lenders want to see. That's what the Fannie and Freddie want to see. They want to know that their lien is the paramount lien on the title, and that these documents don't reflect a superior lien or a superior interest in the land itself. You'll notice that nowhere in the endorsement, and Jeremy, if we can go back one slide for a moment. You'll notice that nowhere in this endorsement do you have to fill in any blanks. The endorsement was designed to be as easy to issue as possible, so it does not require that you go into the endorsement and enter recording information or any particular information about the documents, the agreements or the lease or the financing statement. That was deliberate, so that it can be issued if those exist as a matter of record, but doesn't require the completion of blanks in the endorsement. To the extent that we can design endorsements that don't require blanks to be filled in, it avoids errors and just kind of streamlines the issuance process. So that was an important step that we tried to take in creating this endorsement. You will now. It is important that that somebody take a look at the documents and confirm that, particularly in the case of a UCC financing statement, that it is a financing statement that describes only the solar equipment as collateral. It is possible to record a fixture filing UCC statement where the filer is claiming that there is a fixture on the property that constitutes part of the real property, and therefore that fixture filing could constitute a lien on the title. So it does, in the case of a UCC financing statement, it does require taking a look to ensure that it is simply a financing statement with respect to the equipment, and not a fixture filing that might truly have to be subordinated to the new lender's interest. Then, so paragraph 3 gets the lenders and Fannie and Freddie what they want to know, that these documents, that they exist on the property, don't create a problem for them. Paragraph 4 is important for us. It protects the title insurer by excluding from coverage things like the right of ingress and egress for accessing the solar energy system. So if there's equipment on the property that belongs to somebody else, they may have the right to come in and service it. They might have the right to come in and inspect it. And under various circumstances, they may have the right to come in and remove it. And so those rights of ingress or egress, we wanted to make sure, that was clearly carved out of any coverage under the policy. We also carve out any damage to or diminution in value of the land because of the equipment, or most particularly the lack of maintenance or the removal of the equipment from the property. And then we explicitly want to carve out in paragraph 4C that we are not saying that the lien of the insured mortgage is a lien on the solar energy system. So what this endorsement really does is it identifies there are two separate properties involved in this transaction: the real property that the lender is getting a mortgage lien against, and personal property, the solar equipment that somebody else has an interest or lien in. We think this will be a very effective way of addressing the increasing use of solar equipment, and particularly leased or financed or power purchase agreement type arrangements. So the details about issuing this, turn to your underwriter for any specific guidance. I suspect each company will have some guidance on the process of issuing this endorsement, but it's pretty straightforward. And with that, let's talk about the revised endorsements. Why did we choose these particular endorsements to revise? It was to address the potential of exposure to casualty liability. What do I mean by that? Each of these endorsements provide coverage for damage to buildings or improvements resulting from somebody exercising their rights with respect to easements or mineral rights encroachments, things like that. And I guess a great example is why we revised the ALTA 28. Provides coverage for damage from the exercise of the right to maintain an easement. Well, what we mean by that is if the required maintenance of an easement impacts improvements and causes some damage to that improvement because of the proximity, that there would be some coverage under that endorsement for that. What we don't intend by that coverage is that if somebody is, the power company comes onto the property to service the power lines that run through an easement, and as the guy is leaving, having finished his servicing work, he backs his truck up into the side of the building because he's a terrible driver. That is not the kind of damage to improvements that endorsement was intended to cover. So that's what we mean by casualty risk or casualty liability. And so we wanted to create some clarification. The other thing that we did as in connection with modifying these endorsements is align them with the 2021 policy form standards, which means using the correct naming convention for each endorsement and moving the definitions in the endorsement to the beginning, to section 1 of the endorsement. Let's take a quick look at the ALTA 28 and see what we mean by the changes that we did. So we added a new paragraph. We added an exclusion paragraph. Like we do in a number of endorsements, the 35 series, parts of the 36, the 9 series, various endorsements, we carve out any liability for contamination, explosion, fire, flood, vibration, blah, 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 and negligence. And so this paragraph did not exist in the ALTA 28 until this recent revision. So this paragraph was added to include the language that you'll see in a lot of our endorsements in 2A, the contamination, explosion, fire, et cetera. But we also specifically wanted to add a carve out from coverage for negligence by someone who is exercising their right to use or maintain the easement. In a similar vein, let's go into the next endorsement. The 9 series, we did the same thing. This change is pretty much identical in the 9, the 9.7, and the 9.10, except the reference in section 4, the section reference at the very end of this paragraph is different in the 9.7, but other than that, it's identical. We added to paragraph 5E the negligence carve out for maintaining the easement referred to previously in the endorsement. So these endorsements already excluded negligence with respect to exercising the extraction or development of minerals and subsurface substances. But like we did in the 28, we wanted to also exclude these same casualty type risks with respect to maintaining the easements that are reflected. And then let's move on to the next endorsement. The 36.6 is part of the energy series, and again, we wanted to add that negligence carve out. So as a result of that, the modification to the endorsement was to break paragraph 4 down into an A and a B with contamination, explosion, fire, blah, 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 in paragraph A, and dealing with the negligence carve out in paragraph 4B. And I haven't made these part of this PowerPoint presentation, but in each of these endorsements, as part of making these changes, there are also some additional formatting edits to each of the endorsements. Like I said, we've updated the way the title to the endorsement reads. We're in the process of doing that. Every time the Forms Committee updates or revises an endorsement that was not part of the updated 2021 form package, we are making formatting changes. We've established a consistent style guide for policies and endorsements, and so we're bringing endorsements into conformance with that as we have occasion to work on them. And so those changes are being made as we touch these endorsements. And as part of that, we are also getting rid of the -06 designation. If there are endorsements that we do some kind of update to that were currently known as a whatever -06, we're deleting the -06 reference as we bring these up to date. At some point in the future, ALTA will do a comprehensive update of all of the remaining -06 endorsements and any other endorsements that don't meet current formatting standards. But we put that off until until a better time economically for the industry in order to take on something like that. And with that, I will wrap up. I know we don't have too much time left. Jeremy, if there's a particular question that that you have queued up that you'd like me to address, I'm happy to do that.
Yeah, sure. Great information on the new and revised forms, Dan. And I put it in the chat box. We had a couple of questions if the forms were available. They're on ALTA's website at alta.org/policy-forms. We've received a lot of questions, Dan, but we only have 2 minutes. A common question was about the premium for it. It's going to be handled differently in each state, but any discussion, color you have about that?
Yeah, each underwriter will establish the premium, and it will vary from state to state. As an industry, we don't talk about premiums. That's an antitrust issue. So it is up to each underwriter to establish their issuing standards for the endorsement and the pricing for each endorsement. The filing process is also done on a state-by-state basis by each underwriter. I know some of these endorsements are already available in some states. They are not yet filed. Probably in other states, some states have a longer filing process. Some states are pretty quick. And so you'll need to check with your underwriter or underwriters for whatever state you're operating in about the availability and pricing of each of these.
All right, and we're definitely not going to get to these questions. I'll try to follow up here in the next, give us a couple of days. That we have a lot of very specific questions, as you can imagine, Dan. One question about the 50 and kind of lost it in the questions being submitted. Is the UCC still an exception?
No, the idea is that we do not show. That's a great question, and I'm sorry I didn't make that clear. The goal of the endorsement is to not show in Schedule B the power purchase agreement, the lease agreement, or the UCC financing statement. The goal is to be able to delete those from Schedule B so they don't have to be dealt with, by the lender, in their underwriting process.
Okay, great. Yeah, we're going to wrap up today's presentation. Again, we'll follow up with answers to your questions. Again, Dan, great advice about reaching out to your underwriter with questions about the 50 or any of the endorsements, as each company, may handle it differently. I did want to share that ALTA is developing handouts to help everyone discuss the benefits of the 49 endorsements with consumers. So keep an eye out for those. If you missed part of today's webinar, or if you think others in your office would benefit from listening, again, just a reminder that a recording of the presentation will be emailed tomorrow, and they're always available on our website at alta.org/webinars. I need to thank DataTrace once again for sponsoring today's webinar, and that will bring us to the conclusion of today's presentation. Thank you, Dan. Take care, everyone.
Thank you all.